Hello, options traders. Welcome, everyone. I received an email from one of the traders in our group here asking a really good question. It's one that I get quite often, and that is, should you use a stop order on an option? And it's such a commonly asked question that I thought it would be important to create a video and give the answer to everybody here in the group. But the thing that you have to understand is that there's a very big difference between stop orders on stock and stop orders on options. And unfortunately, when you use a stop order on an option, it destroys the very benefit of using the option in the first place. So let's take a look at why it's not a good idea to use a stop order with your options. First of all, as a little review, what is a stop order? Well, it's nothing more than an automated order to buy or sell. Most of the time, traders use them to sell a position, but we can also use stops to buy. But for example, let's say that you buy 100 shares of ABC stock, you pay $50 for it. And then you're thinking, well, what if the stock price starts to fall? And maybe I'm not in front of the computer and I just want to get out. Or maybe I'll be too afraid to get out. I'd like to have an automated way to get out. That's where stop orders come in. So you go into your broker's platform, you place a second order to sell these 100 shares of ABC at a stop price of some number that you pick. And let's just say that it's 48. But whatever number you pick, that is called your stop price. And it's important to understand that that stop price is not the price that you're guaranteed to receive. That's a myth that a lot of new traders think. They believe that if you put this order in, you're guaranteed to get 48 if the stock falls below it. That would be too good to be true. That would be a free insurance policy. Instead, I want you to think of this number, the stop price, as a trigger point. It's that line in the sand. And what you're saying is that if that stock ever trades at or below this price, or 48 in this example, the order is executed at market. Now, there is a sister strategy to this called a stop limit order, but you're going to run into the same problem. So for this video, I'm just going to talk about the stop order. And with a stop order, you are executed at market. Whether you use stops or stop limits, they are fear strategies. And it's understandable. People put a lot of money into these positions and they get fearful of losing money. But unfortunately, you're going to find that these stop orders, especially when they're used with options, really become more of a stop gain order. They're going to cause far more damage than they will benefits. But it's this fear of losing money that causes people to want to put stop orders on. So how do they work? Well, let's take a look at some examples. Let's say that this is our stock price here, cruising along up here nicely, and on this date, we buy shares right here for a price of 50. Now, of course, at this moment, we didn't know that this was what's going to be happening in the future. But this was our purchase price, and of course, we're getting fearful, so we say, let's put a stop order here at 48. So the stock turns down. Unfortunately, we come all the way down. It trades at or below 48, so we get tripped out there. And for the moment, we feel pretty good. We've limited our losses to just $2. And in fact, in this example, the stock price continues to fall, so we're feeling really smart at this point, feeling like a hero. Hey, we got out, we stopped a loss, or at least reduced the potential losses we would have had. But unfortunately, in this example here, it takes off and goes to all-time screaming new highs, and you missed it. And you think, well, okay, that's just because this stop order was placed too tight. In other words, the 48 price is too close to 50. That's what they call a tight stop order. So you think, well, to make sure that this doesn't happen, let's make it maybe 45 down here. And if this was the path of the stock, yes, 45 would have kept you in, and you would have, in fact, captured all these gains. But the problem with that thinking is you go right back into the same argument. What if the stock instead came down on this path, dipped just below 45, triggers you out, and then goes on to all-time new highs? Well, you think, okay, well, maybe I'll put my stop order far away down here at 40. Well, you can see where this is going. You end up in the same argument. The effectiveness of the stop order depends on the path that the stock takes. Well, in financial risk management, this is what's called a path-dependent strategy. And stop orders are one of many path-dependent strategies. Again, what that means is that the stock's path determines whether the strategy works well or not. And so it really comes down to guessing. You're having to guess where is the optimal time to place that stop. And in that example, maybe it triggers at 48 and goes all the way down to 20 and never looks back. Yes, in that case, the stop order worked beautifully. Great job, super good idea to have put that stop in. But it could just as easily work against you. And again, the reason that people feel confident with using these stops is because of the fear. But the point is that it always comes down to guessing, and guessing is never a good strategy. Well, how can the options help? Well, here's a profit and loss diagram for long shares of stock. We've seen these before in previous videos. For those of you who might not be familiar with reading profit and loss diagrams, there is a video in here. But this is what long shares of stock looks like from a profit and loss standpoint. And what we're looking at here are various stock prices on the bottom, various profits and losses on the vertical. So for example, if you buy shares of stock at 50, right here, and you sell them at 50, what's going to happen? Well, we find 50, we come up here where it touches the red line, we look left, and it shows you're going to break even, which makes sense. You bought and sold at 50. But if the stock comes up here to 55, we come up to the red line, we look left, and we'll see that you're going to make 5. And if it moves to 45 down here, yes, you're going to lose 5. So you're just gaining and losing dollar for dollar with the stock. And it's this unlimited downside risk right here that causes people to want to put stop orders in. You've got a tremendous amount of downside risk. Well, how does that change when you use an option? Let's say that instead of buying the stock, you buy a $50 call. And let's say you paid $3 for it. This is what your profit and loss diagram looks like. So notice we get this sharp bend right here, this little angle, and that will always occur at the strike. So this is a $50 call, but the bigger thing to notice is how it flattens out over here. We don't go on to this unlimited downside loss. By paying $3 for this call option, that is absolutely the most that I can lose. So for those of you who understand synthetics, and there is another video in this YouTube channel here on synthetics, but you know that a call option is the same thing as long shares of stock plus a put option. It's insured shares of stock. So you have to say, if I've already got an insurance policy by buying the call option, why do I want another one by using a stop order? It doesn't make sense to keep piling on insurance policies on top of each other. At some point, you've got to take some risk. So in this example, I have absolutely capped my losses to $3. And that's something I can't say even with a stop order, whether I chose 48 or 45 or 40. I don't know that those are going to be my maximum losses, but I do know it with the option. So the big thing to notice is that the option eliminates all of this downside risk right here. All right, so what's the benefit of that versus the stop order? Well, with an option, it is a time-dependent tool. The option's effectiveness depends only on time. The stock's path has no bearing. Now, don't get me wrong, I'm not saying that the stock's path has no bearing as to whether you're profitable or not. I'm just saying it has no bearing on whether you get tripped out of the order. So going back to our various stock paths that we saw before, instead of buying the stock at 50, let's say we bought the $50 call. Notice that it is never going to trigger you out. It doesn't matter where the stock path went. It could go up, down, could go down sharply. It doesn't matter. Just because it dips below that strike never triggers you out. And that's a benefit. It's a time-dependent tool. As long as that option is alive, you will capture all potential gains and you will always limit your losses to a known fixed amount. And that is something that you cannot do with a stop order. It's a huge benefit for options traders. But now let's step back and take a look at that time benefit. When you use stop orders on long options, that is options you've purchased, you're destroying the time dependency benefit. When you purchase an option, you're spending a time value or an extrinsic value. And that's one of the ways of understanding why that has a big benefit. That is the benefit of a time-dependent asset. That's what you paid for, so it only makes sense to use it. Don't throw it away by putting a stop order on top of it. Instead, select strategies to manage the risk, and that will always put you far ahead of any combination of stock and stops. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionszz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.